It's official. The market is crashing. Let's call it what it is. It's a crash. And it sucks when the market goes down. Even if you're in the accumulation phase of investing, it just doesn't feel good. It's scary. But the question is, what, if anything, can you do about it? After all, you're an investor, not a trader. You have a sensible, long-term, buy and hold portfolio. So when the market goes down, it might feel like you're helpless. There's nothing you can really do except sit there and take the beating, watch your portfolio go down in value, or better yet, tune it out, don't look at the news, don't look at your portfolio, and either way, you just hope for better days ahead. But is there anything that a sensible long-term investor can do besides nothing at all? Well, the answer is yes. There are things you can do, and in this video, I'm going to tell you 4 ways to take advantage of a market crash. All right, the first thing you can do is put money to work. If you have cash on the sidelines that you've not invested because you thought the market was too expensive, well, there's a big sale running right now, so maybe now is the time to put that money to work. Or if you don't have cash on the sidelines, but you are investing regularly, perhaps you can increase those contributions. Maybe at work, you could up your 401k or 457 contributions, or if you have an amount that you regularly transfer into a brokerage account, you could try to up that a little bit. Any little bit you can to get more money into the market while it is lower. For example, I just increased the contributions on my 457 because I'd never adjusted it for the increase in contribution limit. So now I'm putting just a little bit more from each paycheck into that 457. The second thing you can do is rebalance. If you have a split in your portfolio between stocks and bonds, for example, now might be a great time to take a look at that allocation and see if maybe your stock allocation has drifted down, your bond allocation may have drifted up, and you can sell some of the bonds, buy some of the stocks to get yourself back to your target asset allocation. Now, if you are 100% stocks, all in, balls to the walls, equities, well, yeah, you're not going to be able to rebalance and take advantage of this opportunity in that way. But if you have any other kind of asset allocation, or even if it's, let's say, split between US stocks and international stocks, you might find that international stocks have been outperforming US stocks, and now might be a time to sell some of your international stocks, buy more US stocks when they're beaten down more. Rebalancing is a sensible, systematic way to sell high, buy low, and do this in a way that is not market timing. It's simply following the plan that you've already established and rebalancing your portfolio at an opportune time. Of course, you could rebalance and the market could continue to go down, and then you could kick yourself and say, why didn't I wait? But of course, we just can't guess what's going to happen in the market from day to day. One thing you know for sure is that stocks are much cheaper today than they were this time last week. Another way to take advantage of a market crash is by tax loss harvesting. So this applies to taxable accounts. If you have a taxable brokerage account, you may have losses in that account, especially if you made any investment purchases recently. Those purchases may have now gone down in value. They may be underwater, and you can go into your brokerage account and harvest those losses. Basically, sell intentionally to realize that loss, take the tax hit, which will be a negative capital gain, and then you could take those proceeds, turn around and buy a very similar investment. And in this way, you're still invested, but you've captured a loss for tax purposes. And the reason you would do this is that it would offset potential capital gains that you might have either this year or in future years. For example, maybe you are invested in your taxable brokerage account in the S&P 500. It's down, you've got losses. What I might do is perhaps sell the S&P 500, take those proceeds and buy the total stock market index instead, which is a different index, tracking a different index, but it's a very similar investment with very similar expected returns. When you tax loss harvest, you lock in the losses, you realize the losses intentionally to lower future capital gains that you might have, but you stay invested in a very similar investment. If you're tax loss harvesting, you generally want to do it right away. You don't want to be out of the market for too long. You want to sell the investment that's done poorly and then buy the very similar investment as soon as possible. And the fourth way to take advantage of a market crash is by doing Roth IRA conversions. And this is fresh in my mind because I just did that this morning. So my traditional IRA doesn't have any money in it anymore because I've already done Roth conversions in the past. But my wife, however, has a bunch of money in her traditional IRA. And so what I did is I took $10,000 worth of her total stock market investment in her traditional IRA and I converted that to Roth IRA. Now, when you do a conversion like this, the assets will transfer in kind. So in this case, the investment was VTI, the Vanguard Total Stock Market Fund. Instead of having to sell it and have it in cash and then move that cash over, convert that cash over to a Roth IRA, I was able to convert VTI as it stands, as it is, from the traditional IRA into a Roth IRA. We don't avoid any movement that happens in VTI. We're still invested in it throughout the whole process, but it gets converted from the traditional IRA to Roth, but stays the same investment, same number of shares, same everything. And the reason I want to do that now while the market is down is because we're converting the same number of shares for less. It's the same investment, so it's going to do what it's going to do, but I was able to convert the same number of shares for less of a tax hit. So I converted $10,000 worth of these VTI shares to Roth, and it's better to do that now while the price of VTI is down than when it's higher, because that way I'm converting more shares of VTI for that $10,000 worth of tax that I'm going to have to pay. Now, when you do a Roth conversion, there are other considerations as well. You want to consider the taxable income that you expect to have, and that's one reason I didn't do more conversions. I only did $10,000 worth today because I don't know what our tax situation is going to look like. It's still pretty early in the year, but I do think that we'll be in a low tax bracket. We're not expecting a lot of income this year, so I feel pretty good about converting $10,000 worth of traditional IRA to Roth IRA, maintaining that same investment, just moving it over to Roth, paying the taxes this year. No problem at all with that. I think by doing this conversion now, while the market's down, we will thank ourselves down the road when we have that much more money in a Roth IRA where it will continue to grow tax-free. It can be taken out tax-free, and we'll be able to access that $10,000 as a contribution after it's been in the Roth IRA for 5 years. There's a 5-year seasoning period that happens after a Roth IRA conversion. And then at that point, you can actually take the money out early. At that point, acts like a regular Roth IRA contribution. All right, so those are the 4 ways that I came up with to take advantage of a market downturn, a market crash, ways to take lemons and make lemonade out of them. So I hope you found this useful, valuable, or at least interesting. If so, give the video a like, consider subscribing to the channel, and check out this video next on the step-by-step process of how to convert a traditional IRA to a Roth IRA at Vanguard. Thanks for watching.